Hi there, everyone. Chris Reagan from Halon Tax. It's February 5th, 2019. January's over, means your 1099s should be out the door. I know there may be some stragglers, but from what I saw in the social media game, 1099s were not easy. It was a bit of a hard season this year. I think it always is. I go over quite a bit of that in the 1099 lesson that you guys saw previously. There's just no easy way to make 1099s work, you know. Today is a lesson that I have not really taught before. And what I mean is I have not taught about audit red flags ever. And I don't know why. They're kind of a important idea. Clients are very concerned about audit red flags, especially if they walk into a tax shop. They are going to ask, you know, how do we make sure that the IRS doesn't flag us or notify us or notice us or do something to jump into these audits and then give a big penalty, and it's a bunch of, scary stuff. And it can be scary stuff. Today, we're going to go over what some of those red flags are. And as a bookkeeper or financial accountant, how you can be involved in minimizing such things. So it should be interesting. And if you've got a little bit of time, follow along with us, because you may hear about something that you did not know. All right, let's jump right in. So audits do happen. I'm going to show you later some percentages of just how often people get audited. But the reality is they are a part of your client's life, meaning that if they have never been audited, there's a chance that, of course, they could be audited in the future. And it is something, while they may not chat with you too often about it, it is something that they are quite worried about. And what I want to do is jump into some of the, real red flags, some of the triggers, that kind of thing, as we dive into what's both a personal audit trigger, what's a business audit trigger, all of it. So the first thing to know about audits is that the IRS is reporting, and has for a very long time, that the number of audits is actually down. This doesn't mean you should be complacent in worrying about the compliance issues that your clients have, but compared to like the 80s, the audit rates are way down. Back, and this is even before I practiced or got into practicing, but my dad has told me stories about how often both he and the people that he knew were being audited. Both business owners and individuals were either being visited by the IRS or they had to go to the IRS. My dad would tell this story of him having to actually drive to the Capitol where we grew up, which is in Missouri. So he'd have to drive to Jeff City to meet with auditors that were going over his drywall business. And my dad ran a very small one-man, two-man drywall business. So back in the day, the IRS cared about everybody. And now audit rates are quite a bit less. And let me show you this next slide, exactly what the audit rates are. So these are the individual audit rates. This is back from 2016, and that's kind of the way that the IRS statistics work. They don't really give you current information at the statistics center at the IRS. They're always operating off of kind of older information. There are some reports that we're just now getting about the 2013 tax season, if that gives you any idea of how often they report. But if you take a look at this slide, what's interesting is that up at the top, no adjusted gross income actually has a significant audit rate versus those that have some kind of adjusted income or taxable income. And I imagine the reason that no adjusted gross income gets audited more is because there was probably something reported for those folks that they did not file. Maybe they didn't even file a tax return, or maybe they didn't include that amount on their tax return. Then as you start to get into the different income amounts, you can see that the audit rates go down some. So about 0.5% in most categories. Then, as you get into the $500,000 range, we start to see audit rates go up quite a bit. And if your taxable income is above $10 million, you can almost count on an audit. Now, the IRS won't say this, but what I really think has gone on is as they've started to cut budgets and as they've started to cut the amount of people that they have doing enforcement work, what they've learned is they can make a lot more money if they're auditing the folks that make a lot of money. So the odds of our clients, if you have clients that are making less than, say $1 million taxable a year, the risk of audit is really very small. They may go their lifetime, their children's lifetime, and never have an audit. If you make a lot of money, then the audit rate goes up. And the reason I show this slide is to say the risk of audit is very slight, regardless of what situation most people are in. But as we're going to go over today, there are some things to be aware of that can increase your chance of audit and put you into one of these categories. To be selected for audit, the IRS has, I think they have a couple of other systems besides DIF too, but they have one called Discriminant Information Function, or DIF. DIF looks at the deductions, credits, exemptions, what normal amounts are for taxpayers given a taxpayer's income or situation or filing status. And they use that information to decide if someone is outside the bounds of what is normal for a tax return. The first thing I'm going to jump into is these red flags that DIF looks for as it relates to personal tax returns. Here is a slide about the average deduction amounts according to income. And as you can see, we've got different income ranges on the left. And then we've got medical expenses, taxes, mortgage interest, charitable contributions. This gives you an idea of what, given a certain income range, of what the average amount should be. And as a tax preparer, I can tell you that we have several users and taxpayers that often come to us, especially new clients, and they'll say something like, well, for my deductions, just give me the usual or give me the average. And of course, we don't do any of that. We make them prove all of this stuff out. But it goes to show that taxpayers normally know what these averages are. So if someone is doing something from the standpoint of really trying to take a position on a tax return or in a tax situation that's outside of these norms, many times users actually know that, and they know that they're being aggressive here, and they better have documentation to kind of, back that up. Now, some of the things to look for and you can look for this in your practice too, is certain topics. I've got a few on here, but income other than basic wages, for example. So things like contract payments or strange kinds of income, that can be a trigger, especially if it gets reported to the IRS and shows up in the wrong place on a tax return. Non-cash charitable contributions, if those are outside the range of what is normal, those can trigger at least a paper audit. May not mean that an IRS agent shows up at your door, but they will send a notice if they want for you to prove that out. Large business meal deductions, and that law changed quite a bit this year, what we can deduct for meals. Entertainment went away completely, and so that's something that as bookkeepers and financial accountants we do have to watch for. And then large casualty losses I have at the bottom, and with I have a home in Florida. With hurricanes, we do get quite a bit of casualty loss if the insurance company doesn't cover it. And you have to make sure that you prove these things out very well. And at the business level, that's critically important because the amounts of casualty loss could be very large. So as you're managing your practice, be thinking about some of that. And now we have some red flags for the self-employed and small business returns, and this is probably more relevant in certain ways, although I would say that the individual stuff is relevant to all of us as well. But as financial accountants, these pieces are important. As it relates to home office deductions, definitely the IRS, I believe, and this is more opinion, I believe the IRS knows exactly how to find erroneous home office deductions. And something that is passed over way too much in our financial accounting system and by our bookkeepers and by our tax accountants is the use of accountable plans in order to write off home office deductions. So if you've got sole proprietors, meaning they do not file a 1120S or an 1120 or a 1065, meaning that they're not a partnership or an S corporation or something, then home office deduction gets reported in a way that they can kind of do it as long as they follow the rules. They don't have to have a formal plan. But most of you, I know, have clients that are S corporations and partnerships. And if they are, and they're wanting to do home office, you need to be setting up accountable plans for them. And I say this because tax accountants very rarely, in my experience, mention this to their customers. And it's partly because they're not in the day-to-day accounting. And this is why it's so important that financial accountants and bookkeepers understand about the tax side of things, because accountable plans are a really big deal. So as it relates to home office deductions, it's a huge red flag. And if they start to see S corporation owners and partnership owners trying to take home office deductions at, say, the corporate level without an accountable plan, you're going to run into big problems. Also, if you look at the audit rates, if you file on a Schedule C, you are audited more often than an S corporation or partnership or C corporation type of filing. So, and I'm a broken record when it comes to this, especially for your clients that make over about, $15,000 or $20,000. Have them be an S corporation. Have them be a partnership if they have multiple owners. But the S corporation is available to everyone. And really, a really good reason to be an S corporation is just the decrease in the audit rates. The audit rates of S corporations are about 4 times less than what they are for Schedule C filers. And the reason is simple. The IRS knows that Schedule C filers generally don't have as good a documentation, generally probably aren't using bookkeepers, and are in many cases doing these tax returns themselves. So it's just easy pickings. It's like finding the wounded duck versus trying to shoot it out of the sky. You're not going to try and put that much effort into the hard stuff. So S corporations show a level of organization that Schedule Cs don't, and thus they don't get audited as much. I mentioned this one earlier, meals and entertainment. Entertainment's gone. So, and I didn't really hear nearly as much hubbub about businesses not spending on entertainment in 2018 as I thought I would. And what I'm wondering is if they didn't really know that it wasn't deductible, and this tax season they're going to find out. Unless they lived under a rock, I don't know how they didn't kind of hear about it. It was in the news too. But entertainment's gone. Meals can be a real red flag, especially if they look to be abused a lot, especially if they're high compared to what the income of the business is. So be mindful of that. Another item that I think we're going to see a bit more because of the Section 199 deductions, the pass-through deductions. I think there's going to be a lot of folks that start businesses. And eventually, the IRS is going to come looking around and say, hey, are these hobbies and not really businesses? And so hobbies are not deductible. If you claim losses for several years in a row, you're going to be at risk for hobby loss. And that means disallowing your deductions if you're running a business that's running at a loss. And then finally, and this one isn't nearly as easy to audit as some of the previous notes or the topics that we just covered, but claiming losses through your business, especially losses that are very large and are not ordinary, just make sure you've got good documentation on them, because I think this gets picked up more than you would like as well. So if you've got big loss amounts and big expense amounts running through for one category on the profit and loss, make sure you've got good documentation. So as you can see, there's various different things to be thinking about as it relates to red flags. But what I wanted to part with is this. As you're serving your clients from a financial accounting perspective, help them through thinking about what could be an audit red flag. If something looks like a red flag to you, because the transaction comes through the books and you go, oh, wow, I wonder what that was. I wonder if that's actually a business expense. I wonder if we need to have really good documentation because this is 20% of the income, right? Like, let's say they make $100,000 a year and they have an expense that's $20,000. We need to make sure that we're just cognizant of that and documenting it and making sure that come the audit, if there is one, that you're ready. One of the things that has always surprised me, and I'm not in audits very often, but whenever I am, usually audits always come back to financial statements. And those financial statements being an audit always involve the bookkeepers then, or the financial accountants. And they tend to be shocked that their financial statements or some of the work that they did is part of this audit. And I always feel bad for them because the way to approach that with a client is not saying, oh my gosh, well, I didn't know that this affected the taxes. That's kind of a bad answer when your client calls and says, why did we treat this way? Or where's the documentation on this? So always think, if you do find yourself in an audit, say, oh, well, I'm always prepared for this. And I always know this could be an eventuality. And here's why I ask you these questions. And here's why I'm more active in trying to understand what you're doing. And this is why I don't allow you just to brush me off. Whenever I ask you something about a transaction and you say, well, the CPA or the tax accountant knows what I'm doing, say, well, that's not good enough because to some degree, I'm responsible for these books. This is the work that I'm doing. So I would like to know what it is too. So be an advocate for your client, but also be one that is asking questions and trying to find out the heart of issues that kind of make your spider senses, tingle a little bit, right? You know what those transactions are like, and just get into them and see what you think of them. Be aware of these common red flags. And as we are in today, it's Tax Tuesday. So if you have questions about this or anything else tax related, let us know. We'll be in the chat all day today, as we always are on Tuesdays. And if not, have a great day. Thanks for watching, and I'll see you next week.